Thank you to join our webinar today. Barron's Asia is sponsoring today's webinar, and bears in our China shop picking up the pieces in Asia's markets. We are happy to have with us today Wayne Arnott, senior columnist and author of popular Up and Down Asia column, an expert authority to discuss what is happening in Asia markets right now. Please join me in welcoming Wayne. Thank you.
Hi there, everybody. Thanks for joining us. Let's go ahead and get things started. Wanted to start by looking at what's happened with Asian markets. We're used to, those of us who've been in the region for quite some time, and assuming that Asian markets are a place we go when we expect to have better than average growth, better than average returns, higher performance. In fact, that hasn't been the case this year, and if we look back a little farther, we find out that that hasn't been the case for quite some time. Here's a chart I'm showing you now. Trying to get this off of the screen here. You'll see here that Asia has performed pretty well in the past 15 years. Asia Pacific has beat the S&P. In fact, if you look at each year individually for 9 of the last 15, and if you strip out Japan, it's done even better. You'll see there that APX Japan has done about 190% over the last 15 years compared to the S&P 500, which has done 91.5% roughly. I can just help you see that a little bit on the screen. Right there is 91.45. and 190% for the APX Japan index. But most of that, if you'll see here, has come in the first 10 years. And in fact, during the last 5 years, we've had a significant deterioration. In fact, we should be getting kind of used to it by now. Asia has underperformed the S&P 500 since the global financial crisis, and that deterioration performance has been going on steadily for the last few years. Here you can see the APX Japan index has only returned 25% in the past 5 years, compared to 110% or 111% for the S&P 500. That means, of course, that it's paid to keep your money in Wall Street and not necessarily in Asia, where we generally assume we're going to get higher growth. And that includes even large markets like over here. You see Shanghai and the Topics have significantly underperformed the S&P 500, as well as Korea and India, which have come in quite far behind the S&P. You'll notice here that I actually put these in local currency, in yuan and yen. If you do it in dollars, of course, it's a lot different. Shanghai did slightly better, returning 28% compared to that 111% on the S&P 500. And Japan, because the yen went down, did even worse. The Topics gained only 49% over the last 5 years, again, underperforming the S&P 500. So what's going on here, which is interesting, is that total returns in Asia, they generally outperform when growth is going really well globally, but they underperform in really troubling years, in times of crisis or when growth is weak. And on one hand, that might suggest to an investor that emerging markets in Asia are exaggerated proxies for global growth, so they're doing their job for us. But the other theory, of course, is that Asia in general offers a much weaker shareholder return in aggregate, especially places like Korea and Japan that are notorious for having low dividends. And one might even think that developed markets like the U.S. weather downturns better and therefore pay off better in the long run. In fact, if you look at this chart, only 2 of Asia's emerging markets have managed to outperform the S&P 500 in the past 5 years. Over here, you'll see Thailand and the Philippines there have outperformed. Others like Kuala Lumpur and Jakarta have not. They've performed significantly lower than the S&P 500. So what's going on here? There's a more profound change going on, and that seems to be the case, that the superior growth that we've been used to in Asia has been deteriorating, and in fact, that era seems to be over. It's still enviably high. Over here, you'll see this is emerging and developing Asia's growth according to the IMF. It's still above 6%, which is great, except that in many economies, that's lower than what economists would call what they call recessionary growth. In other words, it's not sufficient to produce the kind of jobs to keep unemployment from rising. And that's mostly the case in an economy like Indonesia that has a high birth rate. It's also not high enough growth to support an economy's growth out of a large debt pile, and that describes largely China, where the large debt burden that some economists think is now about 250% of GDP. And here you can see growth is breaking down. The growth is decelerating across all kinds of different economies. These charts, which are taken from Reuters Icon, are one-year moving averages of quarterly growth, and I've done that just to make sure they don't bounce around too much, and you can see the trend here. On the left, you'll see that slowing growth in Indonesia and the Philippines here. There's a slight acceleration recently in Thailand as it sort of pulls out of the uncertainty of the military coup in 2014, but the overall trend is pretty plain. And over here on the right, you see Japan, Korea, and Taiwan also illustrating a pretty clear trend towards weakness. We have passed a sort of a recovery in 2014 and seem to be headed back down again across the region. Now, more broadly, one of the things that's happened, a more powerful trend that investors need to be aware of, is that Asia has kind of passed its peak demographically. When population growth was increasing and economic growth was easy to get, and if you're in a developing economy, that produces easy productivity gains, and growth can be fairly rapid, with it corporate earnings. But in this chart, which I've gotten from the UN and the World Bank and HSBC, you'll see that Japan, of course, we all know, its working age population peaked a long, long time ago. And now China and even Vietnam are starting to get past their peak population growth. And while we don't have the forecast, it looks like that is also true for East Asia overall, which is the blue line here. So add to that list Korea, Taiwan, Hong Kong, Singapore, and even Thailand is not far behind in reaching that kind of zenith in working age populations. That means that China, Vietnam, and Thailand, those countries that haven't managed to achieve developed nation status, risk getting caught into sort of a middle-income retirement. China's working age population actually peaked back in 2010, and Thailand's peaked last year. Vietnam, surprisingly, will peak next year. There are some pretty interesting exceptions to this trend. Here are the three. They're India, the Philippines, and Indonesia, which still have young and growing populations. That means that population growth there will support economic growth and productivity growth, consumption, and income growth. And that presents perhaps a more compelling scenario for consumption plays and a growing middle class that will spend more and buy more and drive corporate earnings in those sectors. Indonesia's population won't even peak until 2026, India's 2040, and the Philippines in 2050. So we've got a long time for those populations. This isn't actually doomed for those countries that are that have hit their peak, of course. So if I go back, there's some interesting trends that happen because of this. As economies start aging, they lose potential growth, but aging consumers stop saving and they start spending more. And that can also turn up opportunities for companies. People who tend to save more as they get further along in their careers, moreover, can help revalue stock markets. There's a gap between when a working age population peaks and when the population of savers does. So how long that takes depends a lot on how widely distributed the population is. But that can support revaluations of the stock market. As people save, they'll drive up stock prices and keep valuations a little higher than they might have been otherwise on average. Hong Kong's savings rush, for example, it ends this year, and so you might expect to see a revaluation lower if that holds true. Singapore is also, that rush towards savings is over in the population. Korea is now in the middle of a sort of a gap between the peak working age population and its savings population, and that won't end until 2019. China's will last until 2027, and we've seen some of the enthusiasm for savings in China's market. It's driven prices quite dramatically and increased volatility there. But there's other fundamental changes going on across the region that we need to sort of keep in mind. One is that Asia is an export-reliant region, and exports are in a deep recession. This is a chart of export growth on a quarterly basis across the region. As you can see here on the right, it's slipped into the negative territory and stayed there and seems to be getting much, much worse. After a sharp recovery after the global financial crisis, it's just been deteriorating. This has been one of the great frustrations and mysteries of the recovery, that Asia's exports are shrinking. And one reason, of course, is that demand is falling in Europe and China and weakening in the U.S. But there are many theories about why the global recovery hasn't turned up demand for exports across the region. One theory, of course, is that manufacturers just shifted out of Asia with costs and gone to Eastern Europe or Mexico. And some say that it's actually just reshoring back to the U.S. and Europe as costs in this region rise. And others, that the U.S. recovery is just not yet a recovery in demand for things. It's still based largely on the recovery in shale oil and in housing, and that Americans aren't yet buying all the stuff that Asia makes. Of course, a more troubling theory on this is that the recovery is not turning into a recovery of demand for things, but more for services like your Uber and iTunes and Airbnb, and that people just aren't buying as much stuff as they used to. That would be bad news for Asia's factories. Of course, a more plausible theory and a little less dramatic is that there's a shift underway in manufacturing and supply chains that started when China joined the World Trade Organization back in 2001. And that shift has run its course. And that means that all the supply chains that were shifting around for the past 15 or 20 years, they've all now sort of settled, and all the re-exports have stopped growing. And therefore, what we're looking at now is a trend of more organic growth in demand globally. And global demand is weak. And so we're never going to get back to the double-digit growth we saw before the global financial crisis. And that means that exports no longer are going to be a bigger part of our growth, and that growth is going to have to come from within domestic economies with less of a transfer of wealth coming from developed economies of the West. Right now, that's presenting us a problem in the stock market because Asia is in a very profound earnings recession. This table is from Morgan Stanley. It's for all emerging markets, but it shows in Asia how earnings have been revised downward across the board. You can see the depth from month to month of earnings revisions. And they've been getting pushed lower for about 4 years now. There's another chart that shows how earnings have been falling. According to Morgan Stanley, earnings have peaked in most of the region. They've been declining for quite some time. They started declining this summer in Taiwan, but much earlier across much of the region. In fact, they peaked in February of 2013 in Malaysia, in 2012 in Indonesia, and in 2011 in India, and haven't been recovering since. So we're looking for culprits for all this. What's the problem here? One problem, obviously, is that China is slowing, and that's the engine of Asian growth. This chart is a depiction of the slowing Chinese engine. What you see here, the yellow line down here, is GDP growth, which has been decelerating. And the white line, that's industrial production. You can see yourself how closely correlated they are. Industrial production, of course, is now shrinking. And official GDP, which this line is, that's not allowed to sink below a certain level. And that level now is 6.5% a year. So China has been trying to keep growth from slowing, and one way it's been doing that since the global financial crisis is trying to use credit, and that got out of hand. Since then, it's been having to find a way to keep credit from diminishing to the point that it suffers some kind of a financial crisis, a Lehman-style crash or a financial crisis with Chinese characteristics. And we've seen some evidence of that lately with more and more defaults, like Shanshui Cement. But here you can see that the ingredients for growth and for credit recovery are very, very weak. This is GDP, this fat line here, and these are housing prices, and those are still actually negative. They're not falling as rapidly as they used to be, but they're still falling. Meanwhile, credit is expanding. This is housing loans, and that's still expanding at double-digit growth, and overall credit is just exploding. So the more likely scenario that we face is that China is going to keep pumping credit and liquidity into its economy to try to avoid a Lehman-style crash. But in doing so, it slips into sort of a Japan-style deflationary coma, in which more and more of this credit is required to keep refinancing or rolling over existing debt. And that means lower growth, lower credit available for new companies' investment and growth. So for the rest of Asia, this is a picture of how things look from China. This is China's imports from the rest of Asia, and you can see, just like exports across the region, they're now in a recession. The region has come to rely to a great extent on Chinese imports. Southeast Asia has slowly given up making final products and instead exports parts and commodities to China. And North Asia exports mostly machinery and robots from Korea and Japan. In fact, the only place in Asia now where exports are rising is Vietnam, which is receiving a lot of manufacturing investment from China as costs there rise. So let's take a look at China a little bit more closely. This is what's been happening in the Chinese stock market. You're probably familiar with this graph. This is the Shanghai Composite, and you can see how it rose, crashed, and then has been sort of locked into a range since the summer. When property prices were falling and capital started fleeing the country, authorities started promoting stocks, and that happened last October, right here where this kind of chart begins. And right around here is where authorities began loosening restrictions on who could open accounts, with how much money, and how much they could borrow and buy stocks on margin. And you can see this green line is the margin levels, and it corresponds pretty roughly with what happened to stock prices. Now, Beijing became very concerned about debt levels in the market, and they cracked down at several points along the way. In December and January, there was a mini correction here. The margin just kept going on and on and on. So in June, they deflated their own rally, ended up here having to come in and bail out investors, you'll all well recall. And most of those margin positions were closed out around here. These positions aren't that much higher than the ones that came in before the rally. And so in the latest rally, what we've seen is most of it's driven just by a small increase in margin positions. And what that says is that this is not necessarily being driven by optimism about the economy or corporate earnings, but rather faith and hope in new stimulus from Beijing. And here's what's happening with the property market. A lot of the money that fled the stock market in the summer ended up back in property, but that recovery has started to fade. This chart, just from Galvacol Dragonomics, shows the early signs of that recovery are starting to fade. So while sales growth surged 19% in July when the stock market corrected, it's now cooled to just 9%, and this chart doesn't show it, but it dropped to 5.5% in October. So that's confirming what Nomura thinks is going to be much slower real GDP growth in China. They're predicting 6.4% in the fourth quarter. So for China, that means that if you're a Chinese saver, you would rather have your money out of the country, particularly if you are worried about a corruption crackdown, if you're an official, and slower growth, or a weakening yuan. It tends to be very self-fulfilling. And people have started to look at foreign exchange reserves as a proxy for what's happening with fund flows in and out of China. And you can see that reserves have been shrinking for this is the growth rate of China's reserves. And here they've fallen negative since late last year. And that means that China's selling its dollars in order to try to keep the currency from falling as money flows out. It's not an entirely accurate measure of outflows. In fact, they're actually probably much worse than the foreign exchange reserve numbers indicate, because they only represent the dollars that China has to sell to keep the yuan from falling. And the yuan is supported by inflows from its trade surplus, which is actually growing because imports are falling faster than its exports. This is a chart of the market of the spread between the offshore market for yuan and the onshore market, the official price of yuan. And this indicates what people think is going to happen with the yuan, which is that it's going to depreciate. You'll remember that in August, China decided to depreciate the yuan by 3%, and there was a massive debate about why that was, whether it was just part of a liberalization effort or whether it was part of an effort to try to promote exports and perhaps make it a little less expensive to defend the yuan. And our opinion is that it's probably a little bit of both. A weaker yuan, of course, helps exports in two ways. It makes them more competitive abroad, as other currencies like the euro, the yen, and the Korean won decline. But it also just translates into more export earnings when those dollars you earn abroad are translated back home into yuan. Now, the People's Bank of China, the central bank, has been intervening fairly aggressively in the spot market for offshore yuan through the forwards markets. But it's very difficult for it to do that in the forward market for offshore yuan. And that's what you're looking at here. So here the market is predicting that the renminbi will be allowed to depreciate about 3% over the next year. And that's despite signs that the renminbi will be added to the IMS special drawing rights basket. Now, the other problem is it's not just China that's becoming more reliant on credit, but the rest of Asia too. This is a chart from HSBC which shows the bank credit relative to GDP. And you can see that we've passed, a long time ago, we passed the levels we had during the Asian financial crisis. And these numbers are not just from China. This is without China, the red line here. This is Asia's overall reliance on credit to keep growth from falling. And the problem with that is that credit is now buying less and less growth. We're getting less growth per dollar of credit. And credit is growing faster than the money supply in a lot of Asian economies. In fact, the only places where credit is generating a new money supply is Hong Kong, India, Japan, Singapore, and Taiwan. And that's where liquidity is actually increasing as authorities try to stimulate the economy. Elsewhere, liquidity is declining, which is bad news for financial markets and for stocks. Now, anyone who's been investing in Asian stock markets in the last few years knows that the fundamentals seem to matter a lot less than what's just happening with global fund flows. So this is a chart of aggregate foreign buying and the MSCI Asia Index. And you can see for yourself that there's a reasonably close correlation between the two. Markets have been driven a lot by how much cheap dollars there are in the market, which way they flow, and which markets offer the highest relative return. So Asian markets are driven less by their own changing fundamentals and more by the outlook for how expensive or cheap is going to be to borrow U.S. dollars. And so recently you'll notice that any suggestion the Fed might raise rates tends to suck funds out of Asia and out of emerging markets. And so while an economy's fundamentals can affect the intensity of the flows in and out, the flows largely determine the direction of Asian currencies. And that, again, it's determined by the Fed, what statements are being made by Yellen and Fed commissioners, and what investors think is going to happen with interest rates. Let me just speak to more to this chart. So what may happen, let's talk about December. The markets now think that the Fed is going to raise rates finally in December. And what will happen then to Asia? Because in 2012, we thought this might happen, and the theory emerged that there would be what people called a great rotation out of higher yielding Asian bond markets or sovereign debt like Indonesia's or India's, and into stock markets of economies that were expected to become proxies for global recovery like Japan or Korea or Taiwan. So that may happen again. And in the past, Asia's stock markets have fallen just prior to and following a Fed rate hike, and then recovered strongly as investors realize that a rate hike generally coincides with improving global demand. Now, this trend started to materialize after late October when the stronger U.S. job numbers convinced people that the Fed was going to raise rates. The trend has since sort of deteriorated as the signals have become less clear and as we've reached a lot of turbulence in the market, especially after events last weekend in France. So the question is, going forward, once the Fed raises rates, will we see an end to the sort of risk-on, risk-off duality of the markets? And can we now position ourselves to take advantage of that by looking for value, so-called, in the markets? So what I've got here is a chart from Bloomberg of the MSCI Asia looking at various measures of value. And there's your traditional price-to-earnings ratio, price-to-book, and enterprise value to EBITDA on the bottom. And depending on which market you look at, Asia does look reasonably cheap. But the question is whether the market will reward that kind of investment, and the answer is no one knows, of course. Asia looks cheap on a price-to-earnings basis, even on a forward earnings basis, but it looks slightly expensive relative to EBITDA, which suggests that earnings are to some extent being driven by the growing debt that we talked about earlier. I can talk about some of these markets individually, which I can do right now. So some of these, one of the best, or sorry, the most, let's say the cheapest markets at this point looks to be Chinese stocks traded here in Hong Kong, unless, of course, you are deeply bearish about Chinese earnings. Hong Kong itself actually looks fairly well priced. Korean stocks and Taiwan stocks also look relatively cheap, as does the topics in Japan, although there are suggestions that it looks a little bit expensive on a price to book and enterprise value ratio, suggesting there that companies are a bit over leveraged and their assets are undervalued. One of the most interesting stories recently to emerge is a recovery in in Thai stocks. Thai stocks, because of the political troubles there in the last year and a half, they've been undervalued and foreigners have been pulling out. Lately, there's been a slight return in interest. And stocks there do look really cheap if you believe that companies can pull off a fairly major recovery in earnings. That seems slightly optimistic given the political uncertainty there and weak global demand, since Thailand is, of course, very dependent on exports. However, if the political situation does improve and the government there, the junta, can improve investment spending, then it would be a great turnaround story. One of the markets that looks very cheap, and we've written about this recently, but probably isn't, is Indonesia. Indonesia is very cheap on a forward earnings basis, but it implies that earnings are going to rise somehow by 60%, and that seems a little bit impossible given the economic outlook for the region and for Indonesia in particular. So the risk there that assets are overvalued. In fact, given that Indonesian bonds yield 8.6%, for most investors, Indonesian bonds might be a more compelling investment than stocks, unless, of course, you're worried about the currency. The same goes for India. Its bonds are also a little bit richer than the stock market in terms of overall return. Indian stocks also look a little bit cheap, although that implies, the valuations imply that Indian companies will somehow pull off a 20% increase in earnings, which, again, even if you're very optimistic about Prime Minister Modi and his reform plans, looks somewhat optimistic, especially given the fact that there's over leverage among a lot of companies. Their books are still very stretched, and given that investment remains weak in the economy. However, India points to something interesting, and you can sort of see it in this chart, is a potential restructuring play. A lot of the markets in Asia are actually very cheap or fairly valued on an earnings basis, but look undervalued on a book value basis and overvalued on an EBITDA basis, or an EV to EBITDA basis. And that sort of suggests to me a potential restructuring play. So if you were if you were a minority investor, a private equity investor, an activist investor, these are markets where there probably are companies that deserve to be restructured, assets sold down to pay down debt and create a lot of shareholder value. And that would describe India, Malaysia, the Philippines, and Singapore, all of which this is true. Unfortunately, and this may be the reason why this is true, all four of those markets are very closely held by either families or government investors. I think a study by Credit Suisse several years ago found out that more than 60% of their market cap is controlled by family-owned companies or government-linked companies. And that may suggest that it's very difficult to go and achieve any kind of restructuring to extract that value. And so they will remain undervalued in this way for some time going forward. One might even call them value traps. So I think that's all I wanted to talk about in terms of the markets. If anybody has any questions, I haven't seen any pop up, but please do let me know. All right. Thank you, everybody, and thanks for attending. Hope you enjoyed it.